Hello everyone, my name is Kamal Manocha. I represent PMS AIF World. In the rhythm of weekly webinar, we have another interesting and important webinar that we were wanting to do for some time now. Before we begin this webinar, I will give a quick context to this webinar. All of us have understood the three factors drive equity markets. The first factor is valuations. The second factor is expected growth in earnings. And the third factor is liquidity. Today, when equity markets in Indian context and globally have been seeing a phase of correction over last 8 to 9 months, at present valuations we see the first factor, which is the valuations, looks to be attractive. The second factor, which is expected growth in earnings, also looks to be attractive. But the third factor, which is liquidity, is the dampener and is actually not at all looking attractive. And that is what is weighing a lot on markets today, all the more to those businesses which are more valued or highly valued or are seen as growth businesses available at expensive valuations, because when liquidity dries, when liquidity comes down, it creates a selection bias in the eyes of analysts, in the eyes of investors, and that is what kind of makes them value conscious. And that is exactly the state of equity markets currently, where over last 8 to 9 months, those businesses which were highly priced, owing to the drying of liquidity, have seen shaving off of the valuations. Obviously, this makes them all the more attractive at current valuations. And given that they are growth businesses, there is more certainty of one making returns in those businesses, provided one remains patient. But these are the times where it requires a fund manager who is following growth style of investing to come and share his views. So here I introduce Amit Jeswani, who follows growth style of investing, and his portfolio management service, Stallion, has been actually giving stellar returns for first 3 years. But since last 5 to 6 months, actually in line with the fall in various growth businesses, even Stallion has been grossly underperforming. Obviously, this leads to the concerns for various investors who have recently invested, and also to the investors who are currently exploring to invest. That is where we thought, let us call Amit Jeswani to explain and share his guidance on his philosophy in the first half of this webinar, followed by which I have a list of questions, which are realistic questions asked by investors, which we will cover. If you have any further questions, if we are unable to cover them in the presentation that Amit has created, you kindly write those questions in the chat box. I promise to you, we will cover all the questions. We have ample time. We normally start our webinar at 5:30, but this is a special webinar. We are starting at 4:30 so that we would have ample time. Over to you, Amit. The entire floor is yours.
Thank you, Kamalji. Good evening, everyone. Thank you so much for joining us today on this webinar. I'll just start the presentation. Kamalji, can you view? Is everyone able to view the presentation? Yeah, good. Yeah. So good evening, everyone. Thank you so much for joining us this evening, Friday evening, for this webinar. I'll just walk you through the small presentation, and as Kamalji said, we'll then move to a Q&A session. So just a small disclaimer before we start speaking about stocks. And so everything that we speak about is only for education purposes. The document has neither been approved nor disapproved by SEBI, nor SEBI has certified the accuracy or the adequacy of the content in the following document. So Stallion Asset, as a lot of people might be knowing, we have two businesses. One's the research desk, one's the PMS business. This webinar is largely going to be about, as Kamalji said, what we expect things to happen in the future. Of course, we've all had some drawdowns, some little, some less. So it depends on the stocks and cycle that you are in. You've had some drawdowns. But what are the typical kind of questions that we hear? And this is the kind of the top 10 questions and things that we hear in every bear market. Some things change, but most things remain the same. Question number one, bottom kab banega? And I will answer that question. Are market valuations too high? Of course, we'll answer this question. How will Stallion invest in the next bull market? We will answer this question. Kya lena chahiye? I will not be able to answer that question, but I will tell you what are the patterns that we would be investing in. Ab value stocks chalenge. That's a very large thing, I would say. That's one thing that so this is not the first bear market that I'm seeing. This is probably the 6th bear market that I'm seeing being invested in the market. And the questions are largely the same. Ab value stocks chalenge. I agree. The value, everyone's chasing value, but people find value in different things. Some people find value in low PE. Some people find value in growth. Some find value in consistency and longevity of that growth. Recession crash aane wala hai. FI kab rukenge? Is the India story over? LIC ka kya karu? This is probably the most trending question right now. Bitcoin lena chahiye, high P ab khatam, buy at any price, nahi chalega. These are the kind of things that people speak in markets. And when you have so much noise, you need to go out with a clear strategy in mind. Kya aaj paisa dalne ka sahi samay hai? Comparison of FD returns to 1-year Nifty returns. Of course, this happens, and if market underperforms for 2 years, they'll compare 2-year FD returns to a Nifty returns. Tomato is now cheaper than you know what. Sirf ITC bachega. These are the kind of questions and things that typically cloud your mind. These are the kind of questions which people ask, and the whole presentation is just 6 slides, 7 slides, and we try to answer the rules that we at Stallion use when we are riding in a bear market to a bull market thing. Rule number 1. So it's been about 10 years that, so for people who don't know me, my name is Amit Jeswani. I'm the founder of Stallion Asset. I'm a CFA and a CMT by education. We've been running this business broadly now for 10 years. Of course, the PMS is 3.5 years old, but this business is 10 years old. We started off as a research desk. Now, the day I started the business, that was probably the end of 2012, 2013. And that time, you had Portugal, Italy, Greece, Spain going bankrupt. Okay, the 2-year bond yields of Greece was 600%. Okay, things were very bad. And last entire decade, I've never seen things as being very good in the markets. Then came 2013. India entered Fragile 5 with Turkey, Brazil, India, and 2 other nations entered the Fragile 5. The rupee went from 44 to 69. All happened in that 1 year. The markets corrected. Raghuram Rajan had then become the RBI governor, and we had a decent size correction in the market. Of course, then Achhe Din came. Modi ji became Prime Minister of the country, and just right after Modi ji became the Prime Minister, in a few months, China started depreciating its own currency, and you had a large 25% knock on Nifty. Now, 25% looks small in hindsight, but we have not even corrected 25% in this cycle in Nifty. We've only corrected 21, 22%. Then came 2016. The start of 2016, everyone was predicting Brexit, that Brexit will happen. At end of 2016, of course, Brexit did happen, and people said that Eurozone will go out. Then came demonetization, and Donald Trump became the president of the US market. 2017, if I go ahead, 2017, you had people were saying that once India implements GST, New Zealand had a big problem, Canada had a new problem, Australia had a big problem, and you'll see a very large market correction because we'll go through a recession as soon as GST is implemented. There were initial hiccups, but I can tell you, 2017 was one of the best years in my life. By percentage gains. 2014 was very good. Then 2017 was extremely good. The difference was size, the amount of money that I was investing in the market. Then came 2018. Of course, that was a bear market here, which started with LTCG, when a finance minister spoke about the long-term capital gain tax. Of course, 10% on long-term capital gain. You had a correction in the market, which then saw banks going bankrupt in India. So you had your ILFS, DHFL, India Bulls, Edelweiss, Piramal, all these companies going through a very, very rough period. And then too, we did okay. 2019, you finally had the bankruptcy of these banks. Yes Bank went bankrupt in 2020. DHFL went bankrupt before. So you had, and people were comparing this crisis to that crisis of 2008 in the US market, that this is India's largest, like India's lemon movement. We will not have credit growth. Without credit growth, how can the country grow? And then we started 2020. 2020, we started the year with COVID. And you had in May 20, and people started saying there's going to be a wave 1, wave 2. Warren Buffett in 2020 AGM compared this correction to 1929 correction. And there was panic everywhere. Yet, when I look at it, and now you have QT, quantitative tightening, which is going on by Fed, there's high inflation. If any investor tells you that their markets are normal without any problems, I can guarantee you he's not invested long enough. Because I have, in my entire career of 18 years in the market, never not seen a problem. There is always a problem in markets. It's a never normal world, and there are never a time that there are no problems in the market. Yet, decent money is made out of markets. So rule number 1, there is always a problem. Rule number 2, there is always a bull market. We don't need the entire market to do well for us. For us to make money, you don't have to think about 6,000 names listed on the benchmarks. All we need is 20, 25 companies in our portfolio to do well. Always remember this. This is what I typically think about. Now we are not stressing about the bear market, the Fed and all that. What we are focused on is, if you think about it, between 2009 to 2014, between 2008 and 2014, the markets went nowhere. That 6-year period, the markets give you zero returns. Yet, I can tell you, there were emerging monopolies like Page Industries, Astral, Bajaj Finance. These companies were growing at Sera, Hawkins, TTK, Sun Pharma, Ajanta Pharma. I can name 50 stocks like this. Whirlpool went up 10x. In these kind of markets, the market starts bidding growth. Wherever the market starts seeing growth, that is where the markets are typically placed. And even in those kind of bear market years, people made a fortune. I would say I know at least 100 investable stocks, 100, which went up 10x in that period. So there is a rule number 2. There is always a bull market someplace. You just need to be there. Last 10 years, Nifty has given 10% returns. Last 11% returns in last 10 years. For last 15 years, Nifty has given 10% returns. You went through Modi, Congress, high inflation, low inflation. In last 20 years, except last 3-4 years, we've always had high inflation. So inflation is not new to India. If anyone looks at data, you'll be surprised to know inflation nahi tha is only for 3-4 years. We've always in India had inflation. We've gone through currency routes. We've gone through pandemic. See, all these problems will always be there. They will come in new forms, new names, but the problems will be there. But there will also always be a bull market. People have made, and the goal is to be with the trend, be with growth and stay in the game. People who say that I will get out of the game, get in the game, I can guarantee you, like whoever I know who's made 100 crores, 1,000 crores in the market. And there was a time in 4 years back, I probably knew 5 people who've made 100 crores plus. Today, I know 50 people who've made 1,000 crores plus in the market. I can tell you they've always been there in the game. They never went outside the game. They stayed in the game. They stayed in good stocks, and they won. So our goal at Stallion is not to say that what is the next 5-10% going to be. 14,000 is the bottom, 14,500 is the bottom. If 14,500 is the bottom or 14,000 is the bottom, the difference is 4%. Why should we waste our time of predicting things which are not in our control? We have to be there in the game at all points of time. And as I said, I'll repeat it. There is always a bull market someplace. Our goal is to be with it and not argue with the markets. When will markets bottom? This is broadly the most important question. Now, this is not a guarantee, but I can tell you one thing. And this is what I use for my own customers, my own models, and my own personal portfolio as well. Typically, greed is a smaller emotion compared to fear. When markets go up, they go up like staircase. When markets come down, they come down like a lift, like an elevator with great speed. Typically, if you look from Harshad Mehta times or even before till now, all Nifty or BSE bottoms are made in 9 months to 15 months. From the 2000 fall, which was the .com fall, it took 15 months for the Nifty to bottom. When you had a 2008 crisis where you had US banks going bankrupt, this is bigger. That is big when banks start going bankrupt in a very large developed economy like US, and there were trillions of dollars at stake. That time also, the markets bottomed in 9 months. When you had the 2010 to 2011 taper tantrum crisis that was going on, and the European, the markets corrected 30%, but that too correction ended in 12 months. 2015-16, during the China devaluation time, the markets bottomed in 12 months. Of course, COVID was something which was unique, where the markets bottomed in 40 days. But typically, all bear market corrections, even if you look at 2018 correction, I've not marked it on the chart. The 2018 correction, where banks were going bankrupt, where NBFCs were going bankrupt in India, the bottom happened in October 2018. And that was like LTCG plus banks going bankrupt, and the entire bottom got created in 9 months. So typically, from the peak to the trough, the markets bottoms anywhere between 9 months to 15 months. Our bear market started in October 2021. Ideally, just going by this pattern, it doesn't guarantee you. But if human emotions are the same and we are hyper discounting machines and we extrapolate today's bear news, bad news into the future, then the bottom should, with high probability, but not a guarantee, get created within now, which is July to December 2022. This is the typical pattern of the markets. I'm not saying this will get repeated, but my idea is, what is the typical bear market? So I don't know where the bottom will happen. All I know, typically, fear is very powerful and the speed of fear is high. And markets doesn't discount the same information twice. So markets will not punish the market for one bad news 2 times, right? And by that logic, we should probably see a bottom in the next 6 months. Within the next 6 months, it can happen next month, it can happen, or might have already happened. I don't even know that. Rule number 4. So we are a $3 trillion economy today, and it has taken us 75 years to reach here. In the next 8 to 10 years, we will move from $3 trillion to $6 trillion. 75 years it took us to reach 3 trillion, and in next 8 to 10 years we'll reach 6 trillion. More money will be created in next 1 decade, between 8 years to 10 years, than that was created in the last 75 years combined post-independence. The question is, how much are we going to make? There are going to be many entrepreneurs. Some will grow this entire decade at 5%. Some will grow this decade at 10%. Some will grow at 15%. I was in London 1.5 weeks back. 1 week back, actually. I was in London, and I've actually studied from London. That's where I did my education. In 2010, when I was finishing my education, the GDP of UK was $3 trillion. That was the GDP when I was finishing. 12 years after that day, this was the first time that I'd gone to London. And the GDP of UK was $2.8 trillion. After 12 years, the growth has been negative. So we in India are very, very, very fortunate that we are going to create in the next 8 to 10 years more money than what has been created in the last 75 years combined. It's a start of a very large trend that I'm seeing in India. Now, a lot of economies have been where India was here, like at $2.5–3 trillion. China in 2006 was $2.6 trillion. In 2010, it became, in 4 years flat, China moved from $2.6 trillion to $6 trillion. In 1981, the US was at $3 trillion. In 1990, the US reached $6 trillion. It took 9 years. Basically, that J curve of India will start playing out very soon. Entrepreneurship in India is 100 years old. Everyone's been an entrepreneur. We've been heard so many, like the grandfathers, grandfathers. There have been so many entrepreneurs in India. What is new in India is hyperscaling. Hyperscaling is 10 years young. The way and the speed at which businesses are scaling is unbelievable. Like just someone from NCPI, we had a con call, was saying that UPI has already reached 11 lakh crores this month. That is $150 billion of transactions happening in a month. Just tells you the kind, and in a GDP whose size is $3 trillion. We are already at $1.8 trillion. $1.8 trillion of payments which are getting processed. This is bigger than PayPal. This is way bigger than what anyone could have imagined. And globally, everyone's still on Visa, on your debit or your credit card. At least the developed world. India has moved. India and China are two nations. In China, it's Tencent and Alipay. In India, of course, we've got many players, but all connected via the UPI platform. While a lot have been spoken. So what do we want? The idea is simple. Hundreds of entrepreneurs out there will increase their profits 10x, 15x from current levels. They will grow at 20, 15, 20, 25, 30% for next decade. And we need to back that. I missed one point. While a lot has been spoken about ethical management, very less has been spoken about capable management. Who are managements who are capable of scaling up and creating that large profit pool? You might be the most honest guy, but honesty doesn't give us returns. It is the capability with honesty. Honesty is a guaranteed. If you're not honest, then of course we can't buy you. But it has to be a combination of capable and honest management. Rule number 4: never bet against India. Stock selection. So our goals are to compound capital at 18 to 25%, and that will never happen if we buy companies that grow anything slower than 18 to 25%. So we'll buy 15% growing company, then we'll buy 25% growing company. So you need a Sehwag and you also need a Dhoni and a Dravid also in the portfolio. So that is how, just like your cricket team, that's how your portfolio is made. The average growth is what I'm speaking about, needs to be anywhere between 18 to 25% of the portfolio for us to generate 18 to 25% returns next decade. So what are the things that we'll need to grow? It has to be a large opportunity size, or else it's impossible for any business to grow at 18 to 25%. I'll give you an example: a business that is growing at 5% CAGR. A business which is growing at 5% CAGR, that means 1 crore of profits today, at end of 10 years will become 1 crore 63 lakhs. A business that grows at 10% CAGR for next 10 years, that means profits of 1 crore today will become 2.3 crores. If a business is growing at 18% CAGR for the next 10 years, the profits of 1 crore will move to 5.3 crores. If it grows at 20%, 1 crore will move to 6 crores. So those are the kind of businesses that we want to be. We want to be with growing businesses. If the profits, think about it, if you're investing in a company where profits are 1,000 crores today and it's growing at 5%, that means profit over the next 10 years will move from 1,000 crores to 1,630 crores. Very unlikely that you'll be able to compound capital, even if you buy cheap, at a very decent or high rates. So what are the key things? There are only 4 ways to grow. 1, volume growth. Now, there are businesses, like let's say, take an example of ITC. ITC has been seeing a minus 4% CAGR volume growth for last 10 years. So we will not buy those kind of businesses. Market share. We ideally want a company to have very low market share. It has to be a market leader, but the competition needs to be very, very weak. So example, ITC, since I took that example, this is not just for an example. ITC has 73% market share in cigarettes in India. So we do not like businesses because no industry in India is growing more than 10%, right? So or a Maruti, okay, we will not buy a Maruti in the automobile segment because Maruti has already got 55% market share in India's four-wheeler, because it cannot grow faster. It'll probably grow at 8% if it's losing market share. If it's doing very well, it'll grow at 13-14%. It will not be able to break out and grow because you need that market share growth. You need 10% industry growth and weak competition, and our company keeps gaining market share. The third thing is pricing growth. There are some industries where there is no pricing growth at all, something like a diagnostic chains. Okay, now there is a lot of competition which has come. Okay, for last 10 years, diagnostic chains in India have not been able to increase their prices. The pricing has remained flat, and now there is new competition coming in. So last entire decade, when the volume growth of diagnostic companies, the listed ones, has been broadly 12% CAGR, and they have remained flat pricing. Now, if you're going to see a pricing degrowth, what do you expect growth to be? So that is the third way of growing, is to ideally you want to have volume growth and pricing growth both, and your product needs to be an inflation hedge. The fourth kind is getting into new pivots, getting into new adjacent areas. Something like an Astral has done it very well. A lot of companies are moving. Reliance has done it very well, pivoting from one opportunity to another. So there are only four things that we focus on: a large opportunity size, it needs to have volume growth, it needs to have market share growth. If you don't have market share growth, it's a problem. In capitalism, if anyone makes money, competition will come with great speed, with low prices, higher advertisement, and more services. The business needs to have a competitive advantage. So as you keep growing, you keep building moats around your business, you keep creating competitive or customer advantage. I'll get back to that point a little later. So a lot has been said about stock selection and why we should buy very cheap business models which are bad in quality, in my very humble opinion. And I can tell you this with a lot of data and a lot of conviction, that more money is lost in buying bad businesses at cheap valuations than buying good businesses at steep valuation. The good businesses, if they keep growing, they'll come back. Bad business, never going to come back. The valuation risk, now that you've already seen a correction in the market, the valuation risk is 20-30% lower. And if the company keeps growing at 20-30%, the stock becomes cheaper by 40-60% in 1 year. And that's the best part with growing businesses. Think about it. Let's take an example of a consumer finance company. I'm just giving you an example just off mind. A consumer finance company, India's number one consumer finance company, the stock has corrected from 8,000 rupees to 5,400 rupees. The business, in my humble opinion, last quarter profits were 2,500 crores. Last entire year profits were 7,500 crores. In my humble opinion, the profits will move to 13,000-14,000 crores in FY23. So the profits will actually go up 70-80%. The AUM should go up 30-35%, and the stock is down 30%. So your pricing in 1 year is 60% cheaper than what it was. So in good businesses, if you get a 30% dip, you buy it. So I'm on the second last slide, the Stallion way of investing. I'll tell you one very important part, and this someday I'll basically have an entire presentation on this one point. Over time, and this is with every industry you can think of, this point is probably one of the most important points. Over time, the market leader of a sector gets 60-70% of total industry profit. You can think about mobile phones, you can think about automobiles, you can think about two-wheelers, any sector. The market leader over time gets 60-70% of entire profit pool. We ideally, the businesses that we back in Stallion, we don't want the business to be just number one. It's good if you're number one. Ideally, we want the management to be the only one. Create that monopoly. There are hungry sharks versus well-fed sharks. So everyone knows there are four kinds of business. A shark in an ocean. These are market leaders with a very large opportunity size in front of them. The second kind of business are a shark in a pond, where the business is big, but opportunity to grow is small. The third kind of business is a fish in an ocean, where the business is small, but the opportunity to grow is very large. There you need to back on the promoters. The fourth kind of business is a fish in a pond. The business is also small. The opportunity is also small. So I'll give you an example. Someone who's selling my glasses, that's a very large opportunity size market. And there, if we get someone 50 crore Indian wears glasses, and the opportunity size. But if someone is selling this tie, that is a fish, or the opportunity size is very, very, very small. So coming to my point, hungry sharks versus well-fed sharks. You ideally want to be in businesses who are 1, 2, 3, 4, 5, 6, 7% of the market. The consumer finance company which I spoke about, that is 1.5% of India's credit market. So India's total banking market is 110 lakh crores. The consumer finance company is 1.8, 1.9 lakh. So those are the kind of, you need 25 such businesses. You don't need one such business, you need 20 businesses across the four sectors that we invest in: consumer, pharma, technology, and financials. The well-fed sharks are, I gave you an example of an ITC, I gave you an example of Maruti. So those are like a Bharti Airtel. It's already 50% of the market. He'll do all capex for 4G. If 4G gets completed, he'll do for 5G, then he'll do for 6G. And that thing the cash will never come to us. So those are businesses that are already very large in market share. They cannot grow beyond the point. You need businesses which are in a very large opportunity, small market share. Our portfolio will typically be a combination of emerging monopolies and proven monopolies. The proven monopolies will grow at 15-20%, whereas the emerging monopolies are hyperscalers. They are typically market creators. They are not just market leaders. They are market creators in so many segments I can think of right now. The one who created the market became very, very, very large. And in the hyperscalers, the growth expectations are 20, 30, 40% also. Customers create market cap. Management creates scale. So if customers love your product, the first way to look if the business will grow better, if do customers really love the product? Management. So customers create market cap. Management has three roles: speed, scale, sustainability. How fast can I grow? How much can I grow? And how sustainably I can grow. So speed, scale, sustainability. So management creates scale. Market leadership creates competitive advantage. And you need all these things for a business to go from 1 to 100. Being too bullish. This is the rule number 6. This is our way of investing. Being too bullish on India or too bearish on India is risky. Unknown unknowns are part of the journey and will happen. Focus on keeping a portfolio beta risk below 1 at all points of time. So except financials, we don't have any debt. In our portfolio, we don't have any debt-led companies, I would say. Our portfolio beta since inception has been 0.84 against Nifty 500. Our portfolio beta against Nifty 50 has been 0.77. So we've taken 15% to 23% lower risk than Nifty 50 at all points of time in our journey. So we're not the high risk, high return type, but we are the growth. So it doesn't mean growth doesn't mean high risk investing. That's a very wrong way. It actually, our portfolio risk has been way lower than the benchmark, and yet our alphas are strong. What we are looking out for is consistent, scalable, durable, predictable growth rates, which is what creates market capitalization, whereas high ROC protects the downside. I've said this point many times. High ROC doesn't mean anything. All it means that it will protect your downside. It is growth that will create very large returns. So yes, so that is broadly about us. We typically invest in 4 sectors: consumer, pharma, technology, financials. We don't do B2G. We don't do cyclical kind of investing. I just have one last slide. Rule number 7. All rules are subject to change. We are a learning organization. We keep learning new patterns, rules, principles, and try hard to get better. In the next 3 decades of Stallion as a firm, we'll learn a lot from Mr. Market, patterns and factors and strategies that work and don't work. If I say exactly the same thing in 2025, that means I've not learned new things from the market. So we keep evolving as a firm. As of now, we believe these are the best rules that we follow. And yes, that's it. Thank you everyone for listening to this presentation so patiently. Kamalji, off to you.
Right, Amit. Thank you so much for sharing your insights. You can kindly stop the screen share now.
Yes.
So you mentioned a very pertinent point that market goes through phases of greed and fear. These two emotions, I would put it more simply. I would say it is only greed. Greed is the only emotion because the genesis of fear is also greed. On the uptrend, you are wanting to actually make more and more returns, and on the downtrend, you're wanting to reduce your losses, and that is also kind of emerging from greed, where you're trying to take home whatever is left before everything evaporates. But ultimately, it is all about conviction. But from this point of view, I want to understand from you, what was your emotion when you added PB Fintech, and what was the emotion when you exited from PB Fintech? Because that happened very, very fast. It was not expected, and many investors have asked us this question. And it would be very, very, I would say, interesting to know the thought behind both these incidents.
Kamal, you put me on a spot when you ask stock-specific questions, very honestly speaking. But I can tell you just one thing. I'll tell you in a very simple way. In our humble opinion, and this is what we get from our own understanding, the free float of PB Fintech is about 93%. Okay. We expect to buy the free float. 93% of free float is allowed to start selling their stock because they're all blocked in November 2022. So we are expecting a 20% supply in PB Fintech. The supply is very, very, very large. And we would like to build a very large. So we took only a tracking position. It was a very small position that we had taken. We're not taking aggressive positions. Our weight, what we had taken, our ideal weight is 4 times the size what we had taken. I don't want to take all sizes here, but we will take 4 times higher size, and we will buy on whatever be the price, be it 500, be it 600, be it 700, be it 400. We want to buy when supply is over in the stock, so that we get very decent return, because there might be some panic selling also. So you don't know what the scenario is. All you know that there's a defined large selling which might happen, not guaranteed, but might happen. I can speak about the business. So our understanding is that insurance business, if you see insurance business in India, it's an 8 lakh crore business. 6 lakh crore is the premium that Indians pay every year. 6 lakh crores is life insurance, 2 lakh crores is general insurance. You read any report, they all speak between 4 years to 5 years. This 8 lakh crore premium will move to 16 lakh crores. PB Fintech does 7,200 crores of premium. That means it is 1% of entire insurance market. It is 94% market share of the insurance in an online insurance. And think about it. You typically buy from a marketplace. You don't buy. Indigo is 60% of India's airline ticket. You don't buy your tickets from indigo.com, right? You typically buy it from Make My Trip or all these kind of yatra.com or all these kind of places. And every great business starts as a research platform. Like Amazon, whenever you used to go Vijay sales, wo bolta tha that 40,000 rupees, I'll give you the AC for 40,000. You'll quickly go and see if Amazon's buying for 35,000, you would buy from Amazon. Same with Zomato. Zomato also initially started as a research platform. And why not just Zomato and this thing? Even Kamalji, you are a research platform. So that PMS AIF World is also a research platform. And that is starting of a great business model, right? Today, You can buy policy from anyone, any distributor, but whoever's buying an insurance policy, he goes to Policy Bazaar one day, let me check. Before buying, let me check that is this guy offering me for a cheaper, like a car insurance cheaper, health insurance cheaper, life insurance cheaper, and is he giving me better services? So coming back to the business, it's 1% of the entire industry, market leader. For last 13 years, there has been no number 2. So I told you, Kamalji, we don't like businesses who are number 1. We want businesses who are only 1. Now coming to the financials, the business has a take rate of 13%. That means if you do 7,000 crores of premiums and your take rate is 13%, that is the commissions that they get. That means your revenues are 900 crores. As of today, they do about 500 crores of advertisement and 500 crores is employee and other expense. 100 crores is the loss on the business. They also have Paisa Bazaar, but that is a separate thing. Now, if you expect the business to, in the next 4 or 5 years, so everyone understood that 900 crores is revenues and 100 crores is losses. You see 600-700 crores losses because of ESOP. That ESOP will go half next year, and then in 1 year is there, and then ESOPs will go away to zero, near zero. Coming to the operating cash flow losses I'm speaking about. Now, if the business moves from 70 to 100 crores of premium today, I'm expecting this premium will move to 30 to 40,000 crores. A 16 lakh crore market, and he'll have 2%. From 1% market share, I'm saying it will go to 2.5%, 2.5%. I'm not overestimating anything. At 40,000 crores and at 13% take rate, the revenue becomes 5,000. Now, do you think the advertisement expense will go to from 500 crores to 1,000 crores, 600 crores, whatever that number? Employee expense will not go up because you also have renewal revenues which are coming to you every year. So what you create is a J curve of profitability, and stocks don't get value based on today's cash flows. The value of a stock is dependent on how much cash you can generate. And think about it. There are 41 insurance players who are fighting in its platform with lower pricing, best services, higher insurance cover, etc., etc. And they are taking underwriting risk. This guy is not taking any underwriting risk. Who would you bet? Would you bet on a red ocean, which is a very competitive market, or would you bet in a blue ocean where you keep getting better with size and you keep creating monopoly? So this is what these are 25 kinds of businesses. Kamalji, 20 kinds of these kind of businesses where we want to bet, where you are dominant. They have 4,500 crores of cash. They have 25,000 crores is today's market cap. Let's see what happens in October, November. We've taken a tracking position. We exited that tracking position. It didn't impact so much the portfolio. It was a very small position, but we will come back on this. We like the business model. If we know a certain supply, and that was the time when Nasdaq was falling with great speed, right? So we and it was a very small 20% this thing, and we got out. But we'll come back to this business. The business we don't leave like that. So it is something which I'm looking at every day, and we'll come back to it. But we have to get that timing also right. What to buy, how much to buy, when to buy, and when to sell. These are the 4 decisions, Kamalji, that I have to take. The when to buy is not, I should not disclose it. Please, this is not that we can do anything. We may not buy it. We can do anything. This is not to tell you what we are going to do. We can do anything. We may not buy the stock. This is just between me and one of our partner kind of discussion. So we're not allowed to speak about my compliance team just tells me that you're not allowed to say what you're going to do. But this is the strategy I'm telling you broadly.
Absolutely. I will be also loud and clear in, I would say, echoing that this is just a discussion from the point of view of investors who are investing in Stallion or who are invested in Stallion. They want to know few questions about the stocks held in their portfolio. If out in the audience there are any new investors, they should not be construing any of the discussion as any matter of advice. One's own, assessment needs to be done. And, to take this discussion further, this is the next and maybe last question on the stocks. I will not ask you any further question on stocks. I will not put you under any soup. But as you said that you will come back to PB Fintech because you like the business model. However, at maybe a better valuation or a lower price when the supply risk is over, which is well understood, and it addresses the concern that you took a wise call in exiting that because you anticipating an event of oversupply coming. With regards to Zomato, another stock which you exited maybe at a better levels, at a higher levels, and you have actually saved 40% downside. Are you at the level where you want to buy it again? Because you loved this business also till 6 months ago. What are your views in that regards?
Kamalji, our average selling price of Zomato has been 125. So it's been very, very, very decent. Okay. So that's why, so we didn't lose any money in Zomato, to be honest. Zomato was not a loss-making trade for us. See, the capital allocation of Zomato, I'm not able to understand. So, Kamalji, when you start with a thesis, my thesis was more on the food delivery side, not on the grocery and all that side. So when thesis changes, you change your mind. And you take your calls. And emerging monopolies are not like proven monopolies, right? Our emerging monopoly portfolio compounds at a very high rate, right? And that's where we do get into, we take 2-3% weights, then we see how things are shaping up. Zomato, we don't intend to buy. Like, I have no intention of buying Zomato. I want that path to profitability, and things have changed between I would say in last 7-8 months. What has happened around the world is a change scenario, and if scenario changes, we also change. So we are not someone who are very stubborn. What we say today is valid only till today, because tomorrow, if some event changes, let's take an example. If tomorrow crude oil becomes $200, okay, I will not say that this business has pricing power, that business has pricing. My views will change, because if I think that is a permanent change, okay. So every change you have to look, and we didn't understand the capital allocation. The reason why we sold it, that we couldn't understand the capital allocation strategy of Dipender Goyal. And when we don't understand the capital allocation strategy, then we do cut weights. But Zomato, we didn't lose money. I would not say that we lost money, but of course we manage our risk. So in this game, you'll make mistakes, and I will, out of 20 stocks I select, I can tell you 6 are going to be duds. But it's not about losing or winning. It's about how much you lose when you lose money, and how much you make when you go right. And when we go right, we don't make 20%, 30%. We end up making like 5x, 10x, and you might have seen in so many stocks of ours. So that is the entire philosophy in emerging monopolies. Your downside is typically 10-20%, but your upside is 5, 7, 10 times. And when you're making those kind of bets, see, proven monopolies is a different segment of the portfolio, where we are happy to compound. If today my EPS is, let's say for any company, if it doubles in 4 years, or let's say it doubles in 3 years, like 25%. Okay. What we think today, Nifty is at 15,000. If this company's EPS doubles, he'll give either 80% to me or 120%. That I don't know, but it will give in that range. Will Nifty give me that much? Will Nifty go up 80%? Will Nifty go from 15,500 to 28, 29,000 and 27,000? So if that is not the thesis, then this stock will outperform for us by 40% or 50%. That's how we look at the proven monopoly side. In emerging monopolies, we're not betting. We're like Sevak, right? So you need a Dravid also. So it's not like we have a bot also in the portfolio, right? And the strategy of a bot is very different. Let's take an example. We have 4% a bot and 4% Bajaj Finance in the portfolio. When today, example, markets are on risk off. So my weights of a bot go from 4% to 4.5%, 5.5%, right? Because everyone's turning defensive and buying. But at the same time, if I have 4% Bajaj Finance and that is down 30%, what we do is we sell our bot and get into our Bajaj Finance. So a bot should ideally give me 13% returns, because the growth rate of a bot is 13%. But we don't end up making 13% because we are selling when everyone's too much bid on a bot, and we are buying when basically we get a hedge. When you get a stock who's negatively correlated to your portfolio, you don't make money equivalent to the growth rate. You make money way beyond your growth rate without increasing your risk. In fact, by decreasing your risk, because then your portfolio betas go lower. So that is the whole play in these kind of bets. So we've got different models, and these are strategies. So it's not like it just happens. We think about it, and that's why we say again and again that we're across 4 sectors: consumer, pharma, technology, financial.
Right. So you can surely, actively manage in between various businesses, and your views can change. And that is the power of active portfolio management service. Absolutely valid point. And obviously, as the macro environment changes, the logic changes. As a fund manager, you ought to make an active change, which is again a valid point. But with regards to the portfolio's philosophy, where you stick to 4 sectors, and those 4 sectors are IT, pharma, consumption, right? IT, pharma, consumption, and what was the fourth one? IT, pharma, consumption, financial. Sorry, the major sector: IT, pharma, consumption, and financial. So these 4 sectors have actually performed very well in last 3.5 years, and that actually gave you a leadership position. But now, in the future, do you still feel that these sectors will continue to perform? Or if any new sector, like for example, in last 5 years, specialty chemicals came out from the bottom. If like that, any other sectors are coming out from the bottom, how will you add businesses from that sector? Will you not be feeling like you are kind of fixated with these 4 sectors? Will this philosophy of yours not become a bottleneck to generate alpha in the future?
So Kamalji, as long as they are not commodities and B2G, these 2 things we will not do. Okay. Now chemicals, if there is a company who's is being the only one who's creating large competitive in a B2B kind of scenario. Okay. So we have covered all B2C businesses. Now comes the B2B part. Now in our portfolio is largely 80% B2C and 20% is B2B. We don't have B2G. We don't believe the money will come back to B2G, and we don't have G2B, where government to business. We don't believe government is the business of market cap creation. They have their own social agendas. Specialty chemical, I would say that is something where, like literally, I'm not this thing. We have 100 calls we've done over last 45-50 days, and we've spoken to probably every agrochemical player, chemical player. So it's not like Kamalji, we have a blind eye or this thing that jo humne bola wo karenge. We keep retesting our own hypothesis that what we said, are we getting it wrong? And we recheck that what can we change. So we are looking at players who can create monopolies in chemicals. And if we get something where we are certain in a B2B business, even the management doesn't know what's going to happen in the next 4 quarters. I'm being very honest, right? How will we as investors know? So in a B2B business, you have to track even more closer what every quarter does to you, because in chemicals, the volatility of prices, okay, is like yesterday I was speaking to a management who did 87% growth this quarter. Okay. He said 20% was volume growth and 67% was price growth. Okay. And so the kind of pricing, and then you have to think on both sides. What will the spreads be, right? What will be the spread of raw material versus the finished good? Because your business is spreads. You're buying a raw material, you're converting into a finished good. So that is the conversion premium. And then you have to see that how many players can convert it and what is the cost at which other players are converting, and what is the competitive advantage that this player has that other players cannot replicate his process. And once you get that, and chemicals, there needs to be a large opportunity. And who's the Chinese? Because these chemicals are not new products, right? They're already prepared in China. They're just moving some part of China to India. So you need to see how big is that player. Is this player losing market share? Are there only 2-3 players, or I have to track 20 players around the world? Is there any big player who's doing a capex? So these are the things. And if you don't know all of this, it gets very difficult to you, for me, to make a 6, 7, 8%, bet on chemicals. Then I'll have to make a 2% with a low conviction but high expectation of returns. And chemicals are not cheap also. So it's probably one of the I would say not so cheap sector in my ways of looking cheap. So my ways of looking cheap can be different for different businesses. Yes, but they're not cheap even when I look at my ROICs, reinvestment rates, etc., because the terminal values are unknown. In chemicals, you cannot say that what is the business today will be the business 5 years from today or 10 years from today, right? You're saying that this is the business today. We'll have to check what the business is 4, 5, 6 quarters from today, because disruptions can come here a lot and moats are not that strong, at least because, and there is no global place where chemicals have made the kind of profits they've made in India. So it's not like Europe, China, America, I can go and see, because all American companies are R&D companies, right? They have the technology. Indian companies don't have the technology. They're the process guys. So the game is very different when you think about it. And the kind of valuation, like if someone in America comes to know that you're getting 70, 80, 90p in chemical companies in India, and think about it, the scale is also very small. So look at the largest, like 500 crore chemical company getting 20,000 revenue. I'm speaking about clean science. 500 crore market cap company getting 15,000 crores market cap, profits of 150 crores. So you keep thinking that what is the size? What is 500? It's not a lot, right? 500 crores, Kamalji. So they're not very sizable, and the opportunities what they are in. So every chemical out of that 500 crores, 200 crores is one chemical. The opportunity size of that chemical is 600, 700 crores. The other chemical is 200 crores. Opportunity size is small. So you don't have a clear path to profitability. Like how I speak about my financials, that this is India's total GDP is 240 lakh crores. India's total banking debt is 110 lakh crores. I'm saying $3 trillion is 240 lakh crores of India GDP. 80 rupees I've taken that price. I'm saying next 10 years it goes to $6 trillion. That means 240 lakh crores. In dollar terms, it goes from $3 trillion to $6 trillion. That means 240 lakh crores becomes 480 lakh crores. But rupee will also depreciate, right? It cannot be like rupee doesn't depreciate. So your GDP will be probably 600 or 700 crores. Now, banking debt as a percentage to GDP is 45% in India, right? It's like if 240 lakh crores is GDP, 110 lakh crores is banking debt, it is 47, 48%. Now, you look at any country in the world, banking debt as a percentage of GDP is 150, 200 as the country. That means you're sure that this is what has happened around the globe, right? So you know that if I pick a guy who's 10% market share, I pick number 2, and this 10% guy borrows at 3%, gives out all loans at 8% to the AAA guys. The other guys are taking loans at 8% and giving money at 14, 15%, and then they have NPAs, right? I'm happy at making that 3 to 8% spread rather than taking that 8 to 14% kind of high credit risk. If you get 2-3 players in financial, then you are certain. In chemicals, so I'm just telling you, why do we choose consumer, pharma, technology, financial? Because we want trends. We want earning growth trends to be very long. Think about it. Chemicals steel also prices moves higher. Okay, they go up higher 3-4 times. But you can't predict more than 1 quarter or 2 quarters, right? And if you don't have that predictability in the market, like if a stock is down 30%, let's say DMart is down 30%, I'm buying DMart, right? I'm buying my Bajaj Finance. I'm buying any other stock. I'm just giving you examples. I'm buying any other stock if they're down 30% because I know the terminal is very large. In chemicals, if we get a large terminal value that we are sure of, like Naveen Sorain, what he's doing in the fluorine space, he's got 10-year contracts with Honeywell, etc. Then that gets us interested that this guy has 10 years of contracts and he's getting new contracts of 10, 15 years. Then we get very confident at 25% ROIC and I will get my growth. And once we get those factors, then we we will buy chemicals also. So we are not averse to anything. We want trends of earnings. That earning trend should be there every year. And once we get it, we get high ROIC, we get a management who we trust, we know what's the market, and then we know the competition so that we can track that if this company is growing at 25% and competition is growing at 15%, then we get happy and we can give him more bonuses at every quarter.
Right. So in the past, Stallion's core portfolio has been large cap biased, but as we see your recent tweets, it kind of conveys that you are kind of more getting attracted towards opportunity coming in the mid and small cap space. Obviously, your own attraction towards that space will have an impact on the way the portfolio construct of Stallion core portfolio will come up in the future. So you want to give any guidance with regards to the allocation of the portfolio, in context of large, mid, small, how you expect it to be, say, over next 1 to 2 years?
So Kamalji, we took a call in October 2021. You're a partner, you know it, that call very well. We took a call of selling off all our small caps and we initiated on that call, except one Saregama, which we sold in March and we got better prices than what were there in. So except Saregama, everything else in the small cap space, we sold it in October and that was a good decision. If you look at those stocks have now tanked 40-50%. I'm saying that, and we moved a large percentage of our portfolio from emerging monopolies to proven monopolies. That is because we don't want to be in cash so much, and we, not that we didn't lose money, we lost money there also, but the idea was to cut our portfolio beta down, which we typically do if we expect a bear market. And how we do it and all that is a separate topic. Now, we think that our emerging monopoly basket, so we exited our Dixon, India Mart, a lot of other players that we exited. India Mart, we made 7x, Dixon, we made 2x, and we exited. Okay, we were the first ones in also. We got Dixon at 6,000 crores market cap. We sold it at 18,000 crores, 20,000 crores at 4,300, whatever that price is. We bought the India Mart last bull market. We bought APL Apollo. We bought Polycab. Polycab, we bought it at 13p. Now the P has gone up. Earnings have gone up. We'll get new emerging monopolies. Okay, we are making small positions. You might be seeing where we are making small positions. These are only 2-3% positions, but we expect, but all of them that we are making positions, Kamalji, they are all again monopolies. All of them should grow at 2020. The emerging monopolies, the patterns are the same. They need to be market leaders. They need to grow at very fast. So it's not like if we are buying any company, I'm tracking it from one day. It's not like APL Apollo became 9x for us, Kamalji, that we were tracking Sanjay Gupta ji for one day. We were tracking it for 5 years. This is a market leader. Jabi, we see a pattern of high growth coming in, we'll get in. And then we got in and then we made money. So now new emerging leaders will come in our portfolio. It's not going to be the same old emerging leaders that will come in the portfolio because you don't get PE expansion again and again. And one big change that Kamalji I am seeing. Kamalji, am I audible? Yeah. One big change that Kamalji I'm seeing. You know, in my 2009 to 2014-15 days, what used to happen? If a stock used to grow at 25-30%, okay, my stock price, if our revenues and profits would grow at, let's say, 25-30%, stock price would compound at 30%, 35%, and more. Every quarter I used to get 25-30% growth, I would get that 35%. You know, like earnings growth, if you get consistent earnings growth, you get very higher stock price CAGR because the valuation premium keeps increasing, right? This was what I was seeing in 2009 to 14. And this same pattern worked in 2015 to 18 and worked very well for me. Now one pattern has changed. Now what I'm seeing is, and this is probably because of information flowing very fast. Now what we are seeing is if a stock is growing at 30-40%, because we do growth investing all the time, 3-4 years of discounting is happening in 3 quarters, right? And if everyone knows it and you are also knowing it, then it's useless. You're getting my point? So my Dixon, the earnings when we bought it was, the revenues were 6,200 crores. The revenues are now 11,900, but the profits. And from my buying price to peak, the stock went up 4 times in no time. So the speed at which people are hyper discounting. I don't know if this was a bull market or information age bull market with a lot of, but the speed of discounting has been unbelievable. And if next bull market also I get that speed of compounding, okay. And if you are early, you'll make your money with great speed. But you need to know that crowd is in, now you get out, right? And yes, so you have to get and understand that game, that this is not the old times where your stock keeps growing at 30% and you get 40, you know. I'm just go to any stock and see what happens when you get 20-25% earnings growth. You'll see stock used to typically do 30-40% every year compounding, but that game has changed. Now it's hyper discounting. Like if the market knows the next 3 years this stock will grow at 30%, in 3 quarters, basically the entire profit that you were going to make in 4 years, you make it in 3-4 quarters. And this is something which has changed a lot that I'm seeing, because I've been doing the same style of investing for a very long time. That this bull cycle, when I write down what are the things that changed, what are my learnings, what are my mistakes, this is the one big change that I saw in markets.
Sure, I'm just in the meanwhile trying to read the questions from the audience, because I think most questions have already been answered. Just trying to find out if there's any unanswered question. There is one very interesting, comment from one of the clients which says, "Can Amitji now answer all the questions on the first slide of the presentation that you had shown?"
Okay, I'll have to go back to the presentation. So we as a team were just sitting last evening and said that these are the typical questions.
They were interesting questions.
Sorry, can you see the presentation?
Yes, I can.
I can't see next year. Sorry. Bottom कब बनेगा 9 to 15 months के अंदर. Our market valuation is too high, depends on the stocks you own. My stocks, I always never think my valuations are too high because the terminal is very large, but I'm either way never a valuation expert. How will Stallion invest for the next bull market? We'll invest in growth, not just next bull market, the entire decade. I am very confident that we would be investing in, we will never invest in bad companies. Your money will always be in good companies, a combination of emerging monopolies and proven monopolies. And the average growth rate should be 18 to 25%. The hyperscalers will also be there in the portfolio, and the proven monopolies will also be there in the portfolio. That's what my view is as of today. We'll do well whenever we have 100% alpha, and this is what me and Kamalji also had a talk, way before this entire correction. I was just telling Kamalji that whenever we reach 100% alpha, we see a 10% correction. And that we are exactly at that 10% alpha correction. If you see from that 100% high that we made, we are exactly at the 10% alpha correction. We will hit the next 100% alpha if we work hard and the gods be kind. But we can tell you, we will work very, very, very hard for you. It's because that's the only way I will win. If you, my customers, don't win, me and Kamalji definitely cannot win. Kya lena chahiye? Look at for now. Look at the 30% growers who have corrected 30%. If your growth is 30% and your correction is 30%, that is the first place to basically bet. But the next 6 quarters, if they keep growing at 30%, in my humble opinion, your money should double easy. But I can be wrong. These are not recommendations. Ab value stock chalenge. Not possible. Value without growth is useless. Recession, crash aane wala hai. Recession, I don't know. Crash, no, I don't think so. So recession can happen if you take your bond yields to 6%. Okay, so today housing loans in US are at 6%, which used to be at 3%. Think about it. If you were told to do at double the price housing loans, example, today the rates are 7.5%. If I tell you that buy housing loan at 15%, you will not buy a house. 15% is unaffordable. So housing demand will this thing. Recession, I don't know, but I can tell you one thing, and I never say this, but example, the other day we had someone from Abu Dhabi over. He was getting massive cash flows and everything, and he was telling me, where do I invest? China, I can't invest, okay, because China has common prosperity problem. You get jailed if you're too rich. Europe, I just told you, when I was studying in UK, the GDP is now lower in 12 years, and this was the first time I went UK after 12 years, and GDP is actually lower after 12 years. You can't go Europe. Except tech, there is nothing in US, right? And now tech will take time because the Nasdaq went from 1,000 to 17,000, and now the tech, once the correction starts, is not like a long-term top has got made. And you would have seen that we've exited our entire Nasdaq, and that is 15-17% higher than today's Nasdaq levels and 100 prices. We've exited our Nasdaq ETF because we don't expect that we will get that 15, 18, 20%. And we were there in Nasdaq 100 ETF from inception. So US, we don't think will lead the next bull market. The leaders of the next bull market will be very different. FIs kab rukenge, God knows. I don't know. But rukenge or ghumenge bhi, that I can tell you. But I don't know when, but it should happen in the next 6 months, within the next 6 months. Bear markets are not very long. They're typically very fast, very painful. But the ones who survive this bear market and you'll have to survive. And I've always said, whenever anyone who's our customer, who's been to our con calls, I've always said that our goal is to compound at 18 to 25% for next decade. At 18% compounding, your money goes up 5.3 times. At 25% compounding, your capital goes up 9x. We'll do anywhere between 5x to 9x in 10 years. But there'll be 2 bear markets in between. And the ones who get out at these point of times, they will never make money. The stock market is not for them any which ways. So is the India story over? Up to if 2024, this I should not say, I should be politically correct, but if 2024, Modi ji is coming back, you should expect unbelievable growth, because the world is looking at India. There is no other place for growth. Where will the money go? There has to be an option. LIC ka kya karu? I swear to God, I don't even know the stock price of LIC, but I know it's below 700. Like 2, 3, 4 days back, it was below 700 because someone asked me that. So I don't even know, because there is no history of data or financial data. How do I see what happens in high inflation, low inflation? What is the equity risk? It's very less data is there, for very difficult for me to even understand the business. It's too big. It's beyond my pay grade. Let's just say that. Bitcoin lena chahiye, can't comment. Bazaar kya lagta hai? Be aggressive. I'm investing decent sums of my capital every month for the next 6 months. That's how I'm going about it. High P, game khatam. See, high P without growth, to game to chalu hi nahi hona chahiye tha, right? But if the growth continues, and what is high P depends on various factors, right? Like, I can't say a lot of things, but I'll give you an example, like IT services. Okay, if Infosys used to grow at 8%, okay, it would get a 16% P multiple. When Infosys starts growing at 15%, it gets a 30 P multiple. So your P multiple is typically in IT services 2x your growth rate, except TCS, where the P multiple is 2.5 times the growth rate of, like if TCS grows at 12%, the P multiple will be 26 times. So these are things that you'll over time learn, that how a free cash flow growth company gets valued by market on various things. But these are just heuristics, and this is how market looks at it. Kya aaj paisa dalna chahiye? Absolutely dalna chahiye, but sahi ghode pe dalo. And you know what I mean by ghoda, stallion. But yeah, I'm very confident. If you invest for within now and next 6 months, you should do very, very, very well. The next peak. So every 4 years there's a bull market. It happened in 2021. It happened in 2017. It happened in 2013, 14. It happened in 2010, 2007, 2000. The next bull market will come in 2025. Between now and 2025, you need to change your net worth. And every 3-4 years, you need to take a 3-4 year view and increase your net worth. If we don't make money this decade, then it's our mistake that we didn't get rich. So, in my humble opinion, it's a good time to put in money. Comparison between FD returns to Nifty returns, never do it. There are 2 different asset classes. Treat them differently. Tomato is cheaper, yes. I don't know about inflation, but Zomato, I've already said that we don't own in our portfolio. We sell out. Sirf ITC bachega, I don't know. I don't know so much about ITC. See, you want ideally not 15-20,000 crore profit pools, right? ITC profits are 17,000 crores. Now you think that where will this profit pool go? You ideally want smaller market shares. You don't want 73%. And my humble opinion is reinvestment. 100% of capital is reinvested is the best. The reinvestment boards give you the best returns. The second best is combination of reinvestment and buybacks. The third best capital allocation is buybacks only. The worst capital allocation is dividends only. If I had a good growth company, I was getting a 10-15 P, I would do aggressive buybacks, and that's how my shareholders make money. But Kamalji, that's broadly the questions that these are my.
The last question, you have covered all these questions, which are basic questions of, I would say, amateur investors, as well as today, the anxious investors who have their hard-earned money invested. So obviously, you answered them really well. But one last question, which, should cover your forte, because I understand that your strategy, your, team's focus is to identify the leaders of the next bull run in terms of sectors and then businesses within those sectors. So you have given your guidance with regards to the expected future. But, in last 2 minutes, if you can give your kind of, I would say, advice or viewpoint on what are the top 3 sectors in the order of 1, 2, and 3, as per your understanding at the present.
See, I'll tell you what will work. Focus on growth, and that growth needs to be backed by price action. Okay, Let's take an example of auto index. Okay, it has corrected less than 5% in this entire. It has not given a COVID high also. Okay, it has corrected 5%. In the fact that it is outperforming by so much, there are about 16 auto ancillary companies in India and about 6-7 B2C players in India. Escorts, M&M, iShirt, TVS, whatever, 6, 7, 8. Study all these 20 companies in next 10, 20 days. I would say something is happening because I have not seen this kind of price action. This is my price action formula. This is one sector I've given you. Number 2, look at growth. Where is the growth coming? So logistics you can look at. That's a sector where growth is coming. All stocks are now hitting new highs. Okay, and people were saying before GST that logistics is 95% unorganized. Big money will be made once GST comes. Big money will be made, but no money was made. Actually, there was no growth also coming. But now, if you see, there is growth coming. The one of delivery got listed. So when delivery gets listed, when a new IPO gets listed, the other players in the same segment, people start, and delivery got a $7 billion, $8 billion valuation. So now you start seeing that how can one player get $8 billion? He's getting $8 billion because market believes that he will get 60-70% of the entire logistics profit pool. Okay, I can tell you that is how markets are. They think on TAM. Okay, now but 60% hoega na, baki 40% baki hai. Who are the other players who can get that 40% in this thing? And there are 3-4 businesses here. So that is one place that you can look at and just focus on which, and that growth needs to come with price action. See, whoever you are, if the market doesn't agree to your thesis, okay, in the point of time, you can't show, like I can't show my customers my businesses grew at 40%. I need to show them the portfolio grew at 40%. Okay. Once you get a growing business and it gets confirmed by the stock price action, you will win in a very big way. Catch trends, and that growth should be every quarter, every year, 30, 20%. It should not be cyclical. So the ones who, let's say, like October, I was asked that why don't you have steel in your portfolio? Kamal ji would remember, and all these kind of, and I said that this is not our cup of tea, and we know now the stocks are down 30-40%. Nobody knows, should we buy more steel or sell a Tata Steel now from 1500 corrected to 800? And if you don't know what you'll do to a stock 30% below your price, then it's a problem. Like I know what stocks I will hold and I know what stocks I'll sell. I know the difference between the eggs and the balls in my portfolio. So the eggs you have to sell if you get a 30%. So to your point, why didn't I buy chemicals? Because I didn't have that conviction that 30% if I will sell or buy more. Because chemicals are, even I'm telling you, the entire industry profit pool was 400 crores chemicals, and now you have a very large profit pool. But so that is our way. So look at growth. So this is too early in a bear market. Trends will, so see, okay, this is my way of looking at things. I typically, so only in the first phase of bull market you will be able to identify the leaders of the next bull market. Don't try to identify the leaders of the next bull market in the falling market. We are, let's say, 80% proven monopoly, 15, 16, 17% emerging monopolies, and 3, 4, 5% probably we have some cash also in the portfolio. 6, 7% I think we have cash. Now, slowly, as we get, this quarter is the first proper quarter we'll get inflation, this thing, inventory will go away, and this quarter is not going to be so bad, I feel. Once we get an idea that who are the leaders of this cycle and who is able to pass on prices, then the markets will start bidding. The markets are not supposed to be 500 stocks hitting new highs every day. In a typical bull market, I have not seen more than 100 stocks doing well out of 6,000 stocks. And markets are supposed to be narrow. They're always narrow. Only sometimes like 2017, 2021, they're broad. And everyone makes money. And it's the same game. What everyone does, chalo bhaiya, compare with a 100 PE stock to a 30 PE stock. Then what they'll say that 100 PE, like compare a underwear company, small underwear company to a large underwear company. Okay. And they'll say, yaar, ye to abhi 15 PE pe lux hai, 100 PE pe page hai. Bhaiya, wo वैसे ही होने वाला है. There are cycles in which you'll make money and then you'll have a drawdown. And that is how markets are. Like there are some stocks which are different. The market views every stock differently, and you'll have to do things according to the market. You can't be very different from the market. So growth and price action, if you get these two things, be very aggressive in the bear market. There is no reason for you to be defensive for next 10 years. Like, I don't find a very this thing, and I'm putting my own money for the next 6 months. Like 6 months, I'll be very, very, very aggressive in the market. But proven monopolies keep it different. The emerging monopolies, you need a combination of both, because in an emerging monopoly only portfolio, you'll have drawdowns, right? And it'll be difficult for you to sustain those drawdowns. Today, my drawdowns is equal to broadly other portfolio managers, so I don't have to worry too much. 2-3% higher low, that is okay. We made way more money than others in a bull market. Sometimes we're down 2-3% extra, no problem. We'll get it back in no time. We just have to move back to our emerging monopolies basket, and we will. Kamalji, in the next 6-8 months, the allocation will slowly and steadily. Now we don't want to be more defensive. The point of being defensive is gone. We are already 20% broadly down on Nifty, 18-20% down on Nifty. And in 6 months, as we keep getting conviction, this quarter will be the big quarter where we start making changes towards the emerging monopoly part. So that was the answer, a big one, but that was the answer to your question of how the portfolio will go to 40-50% emerging monopolies from 18-20%. Over time, 40%, 60% is the view. 60% proven monopolies, but the proven monopolies are also growing at 25-20%. So it's not like they are not growing. The both sectors we are growth investors. We want long-term sustainable growth.
So currently, your largest sector is consumer discretionary.
Yes.
With, I think more than 30% weight.
Yeah.
So are there any positive factors with regards to the current market macro environment which are conducive for these sectors that your weights are so high in consumer discretionary?
No, so if you think about it, all our stocks that we are buying it's largely retail is where the holding retail and building material where we are long. Building material, you have one wires company we have Delhi-based structural steel tubes company. We bought one Celebration where play in retail. The growth will be 20-25%, and you're getting ROEs of 70-80% in these names. All these names which we are buying, and these are very good businesses. Like, I'm not able to say, because I'll have to tell the entire thesis out, because these are new positions, we're still building our positions. But retail will lead, because retail, if you see, one player, every retailer, okay, is 5%. The biggest retailer we know from QSR is 1% of the entire market. The QSR player we own. The Celebration wear market we own, it is 0.4% of the entire market, right? They are only on the men's market right now. If they go to the women's market, sky is the limit. And even if sky is not the limit for next 2 years, so I have 25% growth, 20-25% growth. And they didn't do badly in bad times also. So when you look across this thing, they increased their profit pool compared to industry 2 times. And when the industry is still struggling out of COVID in retail, these guys are going up there and creating. Retail is one of my favorite places. In retail, so we have grocery retail, we have jewelry retail, we have Celebration wear retail, we have QSR, restaurant retail. Retail is where you'll make the largest one. FMCG, if we find, we have FMCG also in the portfolio, but they cannot be very large portion. I don't want to keep all my money in 10% growers. I want to have 20% growers, but 40-50% ROC. So my downside protection is same, but my upside is double of that of FMCG. And you have to take a view from now to 2025, because the next bull market top will be 2025. You need to see that if I'm buying this at ABC PE levels or ABC growth, what will be my growth? Like I gave you an example of PB Fintech. You're buying FY26. FY26, if they have 3,000 or 30,000 crores or 40,000 crores of premium, then you start thinking reverse, that if this would be the premium, what will be the advertisement cost? If profits are 1,500, 2,000 crores with ROE being unlimited and growth being 30% plus, market gives DMart 100p. How will this is a better business model than DMart or worse business model? Market gives Page Industry 80p because he's only one, right? Then you start thinking that how will markets value these businesses? Because free cash flow growth of 30% is not a very difficult thing to understand, that how market values an only one kind of business, not number one, only one kind of business, competitive advantage. And then you come with thinks that what valuation will it get? Will it get whatever valuation? You say that if I buy at 100, will I get 500, 700, 2000? What is my worst case scenario? When do I exit? If this doesn't happen, I exit. And that's how you make your entire portfolio.
Right. So this is the last question. Amit, you have spent almost 1.5 hours. It has been really insightful talking to you. And the last question is with regards to your portfolio. You mentioned that, one of the top sectors that comes to your mind is auto, where you're seeing a lot of action happening. And I also kind of noticed that. Do you look to add any stock from that sector in your portfolio?
Kamalji, actually, we're meeting 2 managements tomorrow. We're meeting 3 managements on Monday. So because we've not tracked auto so much after 2017. 2017 we sold out auto ancillary. After that, because the growth rates were slowing down that time. So that was the time when we sold out our auto ancillary. And the last auto ancillary company I've not bought in 4 years, very honestly speaking. But the screen is telling me that you should buy. But I'm just seeing that what is changing in the industry. And like example, there is one 800 crore market cap company. He's got a 175 crore machine order, EV machine order. We're looking at it. Ola has given an order. Hero Electronics has given an order. There are so many companies. There is one LED light company. There are only 2 players in the LED light market in India. We're looking at who are the guys who can basically scale. Because if you think about it, auto topped the 2-wheelers and the passenger vehicles. Passenger vehicle sales are down 30% from 2018 levels. And 2-wheelers are down 25-30% from 2018 levels. So a country like India, automobiles have actually degrown in last 4 years, right? Now you have to say that what type of consolidation has happened? Who are the players in a bad market who are able to do well? See, there is not many scenarios where you'll get a 30-40% kind of volume decline in Indian automobile market. And now it's a good time for you to understand the managements, that which management did what. So we will go and read all 15-16 con calls. Like in 4 years, if we've not tracked, we'll go and see all 15-16 con calls. That which management did what, how are they building monopolies, and what is the growth. That are they only on the IC side, or they made in a bad market. What changes you do will make sure you become big in the next bull market, right? So how you handle a crisis will tell you a lot about how you will win the next bull market. So yes, there is something coming in auto. Like if for 18 months, SUV 700 is booked, like M&M, right? And when you see here these kind of things, you remember that Aisha kind of scenario that every quarter you get 40%, you get excited. That is there one company who can do something like this. So we are looking at this space now very carefully. And we are meeting a lot of management. And what we do is very easy, Kamalji. We ask one management house this one. We ask the other management house this one. And so that we get a very good hang that who's doing what. And because there are only, say, auto ancillary companies have only 6-7 customers. Auto ancillary companies don't have 40 customers, right? They know everything about their customers, and they also know everything about the competition. And when you speak to 10-15 people in the business, you get a very good hang. And we will be speaking to the entire auto ancillary sector. So if there's an analyst watching this, please connect us to all auto ancillary management. But yes, we'll be speaking to everyone next 1 week for sure. If price is telling us, then it's giving us an invitation. What more higher invitation we want? So we'll be looking at it. I don't know what we'll do, but we'll look for sure. We will read and skip, not skip without reading.
Sure. And you're talking about the core portfolio, not any new portfolio. Adding this in the core portfolio or any new portfolio?
No, this is the core portfolio. We have only one portfolio. So This will be only one. We don't have multiple products. This is one product where I have my money. Everything is only one product. We'll see, because very early to say that what we'll do. But that is one sector that we are looking at right now.
It has been really pleasure talking to you, Amit. We have, I think most of our questions have been answered. I have one or more 2 questions, but I will not cover them this time. Maybe next time we'll take those questions. But I think the audience has been asking many questions. Most questions were answered without they kind of, covered by you in your presentation. Thank you so much for your time, and thank you everyone for logging today. I think I hope we added some value to our clients. I would just want to add that our conviction during these times, and perseverance during these times, and patience during these times will, as Amit mentioned, will actually determine our experience over next 3 years. We have written a lot of articles over last 6 months to help our clients and our investors kind of maintain their conviction. I would urge all our clients and investors to kind of read those articles, because obviously the content that we have written comes with a lot of experience and comes with a lot of investor side experience, and that will actually give you a lot of comfort, and it will ultimately help you keep the conviction. Thank you so much for logging in today, and thank you, Amit, for your time.
Thank you, Kamalji. Just please note, all stocks which I spoke about are just for education purposes, and we were having just a friendly discussion. These are not recommendations, these are not advices from either me or Kamalji. We are an asset management company. We keep making buy-sell decisions all the time. This is our business. We are in the business of managing money, and these are not advices at all. Thank you, everyone. Thank you, Kamalji, for this. Thank you so much. Bye.